Before we begin, please remember that I am not a licensed financial advisor or insurance agent. This presentation is for educational and informational purposes only. The information provided is not intended as financial, legal, or insurance advice. Always consult with a qualified professional before making any decisions regarding your insurance coverage. $435. According to financial experts, that is the average amount of money the typical American driver overpays for car insurance. Every single year. That's a new phone, a round-trip flight, a serious dent in your credit card debt, just vanished into the pockets of a multi-billion-dollar industry. But here's the crazy part. For many of you watching this right now, that $435 figure is a wild underestimate. For me, it was closer to $1,000 a year. For almost a decade, I got my first insurance bill when I was a teenager, and I remember staring at the number, completely baffled. It felt impossibly high, but my parents said, "That's just what it costs." So I accepted it. For the next 10 years, I was what the insurance industry calls the perfect customer. I never missed a payment. I never had an at-fault accident. I stayed with the same company year after year, thinking my loyalty would be rewarded. And every 6 months, like clockwork, my rate would creep up. A few dollars here, a few dollars there. I'd call and ask why, and I'd get some vague answer about rising costs in your area or new rate adjustments. I'd sigh, accept it, and pay the bill, because that's what we're taught to do. The turning point came when a coworker who drove a newer, more expensive car than I did mentioned he was paying less than half of what I was. Half. I was floored. It didn't make any sense. That conversation sent me down a rabbit hole that completely changed my financial life. I spent the next several years obsessively researching, reading dense policy documents, talking to former insurance agents, and testing every savings strategy one could find. And what I discovered is this. The auto insurance industry isn't just confusing by accident. It is confusing by design. It is built on a foundation of complexity, fine print, and our own inertia. They count on you being too busy, too intimidated, or too complacent to ask the right questions. They have a name for it. It's called price optimization. It's a quiet, perfectly legal practice where they use sophisticated data to figure out which customers are least likely to shop around for a better price. And then, they slowly, systematically raise your rates over time. Your loyalty isn't rewarded. It's monetized. You're not a valued customer. You're a captured revenue stream. This video is the antidote. This is your wake-up call. Over the next 10 parts, we are going to systematically dismantle every myth, every confusing term, and every pricing trick the insurance industry uses to keep you overpaying. This isn't going to be another fluffy list of top 5 tips you've already heard 100 times. This is a complete masterclass. My promise to you is simple. If you stick with me through this series, you will walk away with a PhD in your own auto insurance policy. You will understand exactly what you're paying for, you'll know precisely what coverage you need and what's just expensive filler, and most importantly, you will have a step-by-step, proven playbook to slash your premium by hundreds, if not thousands of dollars a year without sacrificing a single drop of critical protection for you and your family. We're going to start by breaking down the 6 secret pillars of your insurance premium. These are the core factors that actually determine your rate, and I guarantee you they are not what you think they are. We'll expose the so-called discounts that are often just marketing gimmicks and reveal the powerful, hidden discounts that agents rarely volunteer, unless you know the exact magic words to ask for them. Then we'll tackle the single most expensive mistake millions of drivers make, choosing the wrong liability limits. You'll learn why buying state minimum coverage, which sounds like a smart way to save money, is actually one of the riskiest financial gambles you can possibly take, a gamble that could bankrupt you after even a minor accident. We'll demystify terms like comprehensive, collision, uninsured motorist, and personal injury protection, so you can look at your policy declaration page and know, with absolute confidence, where your money is going. From there, we'll dive deep into the surprising things that are nuking your insurance score, things that have nothing to do with your driving record. We're talking about your credit history, your zip code, and even your job title. Yes, your job title. A teacher can pay a different rate than an engineer, even with the exact same car and driving history. You need to understand how this game is played. And finally, in the later parts, I'm going to arm you for battle. I will give you the exact word-for-word scripts to use when you call your insurance company. You'll know how to counter their objections, how to leverage competitor quotes, and how to politely but firmly negotiate your way to a rate that you deserve. We'll explore the best tools for comparison shopping, so you can make the entire market compete for your business in under 15 minutes. Let's bust a huge myth right now. The myth that saving money on insurance means you have to get a worse plan or switch to some sketchy no-name company. That is completely false. In reality, the most overpriced customers are often the ones with the best driving records who have been with major brand name companies for years. The goal here isn't to be underinsured. It's to be smartly insured. It's to stop anonymously donating your hard-earned money to a company that sees your loyalty as a weakness to be exploited. This is about taking back control. It's about transforming a confusing, frustrating expense into a tool that you understand and command. Imagine opening your next insurance bill and seeing a number that's 30, 40, or even 50% lower than what you're paying now. What could you do with that extra money? That's not a fantasy. For millions of people, it is an achievable reality, and it starts right here, right now. So get ready to take some notes. The information in this series has the potential to save you tens of thousands of dollars over your driving lifetime. It's the financial education none of us ever got in school. Before we dive into the very first secret, the 6 pillars of your premium, I want you to do something for me. Pause for a second and think about what you're currently paying for car insurance every 6 months. Now go down to the comments and type that number in. No judgment, no shame. Let's just get a baseline. You're about to see just how much room for improvement there really is. Let's begin. Alright, you've got your number. Look at it. That's your starting point. That's point A. And our goal is to get you to point B, a place where that number is significantly, shockingly smaller. But to get there, we have to first expose the single biggest lie in the auto insurance industry. It's a lie so deeply embedded in our culture that we don't even see it. It's the idea that loyalty is rewarded. Let me tell you a story about a guy named Dave. Dave is a good guy. He pays his bills on time, drives a sensible sedan, hasn't had a ticket in a decade. For 15 years, he's been with the same insurance company. Let's call them All-American Mutual. Every 6 months he gets his renewal notice, sees a small increase, maybe $10-15, and thinks, well, inflation, I guess. He even brags a little to his friends. Yeah, I've been with All-American for 15 years. Got that loyalty discount, you know? Dave feels good. He feels secure. He believes his loyalty means the company has his back. What Dave doesn't know is that his loyalty isn't a benefit. It's a target. His insurance company is using a practice that insiders call price optimization. That's a fancy corporate sanitized term for a simple, brutal strategy. Figure out the absolute maximum they can charge a customer before that customer will finally get annoyed enough to leave. They are betting on your inertia. They're betting on the fact that you're busy, that shopping for insurance is a hassle, and that you, like Dave, believe that your loyalty is earning you a good deal. So they raise your rates. Not all at once. Never enough to cause a big alarm. It's death by 1,000 cuts. An extra $12 here. An extra $18 there. Over 10 years, Dave's loyalty has cost him thousands of dollars more than a brand new customer would pay for the exact same coverage. He's not paying for his risk. He's paying a tax for being complacent. He's paying a penalty for being loyal. This isn't some conspiracy theory. This is the documented business model. Major data analytics firms build complex algorithms for insurance companies with the specific goal of predicting your break point. They analyze your age, your credit history, how often you use their mobile app, even your web browsing habits, all to build a profile of how likely you are to shop around. The less likely you are to shop, the more they squeeze you. Your loyalty discount? It's a marketing gimmick designed to make you feel appreciated, while they slowly pick your pocket. It's a pacifier to keep you quiet while they raise your rates. One day, Dave is at a barbecue, and his buddy mentions he just switched insurance and saved $700 a year. Dave scoffs. Nah, can't be. I've got the best rate. I've been with my guys forever. But a seed of doubt is planted. That night he can't sleep. He pulls up a quote comparison website, plugs in his information, feeling a little guilty, like he's cheating on his trusted insurance partner of 15 years. The results load. The screen fills with numbers. And Dave's jaw hits the floor. Company after company is offering him the exact same coverage. In some cases, even better coverage for $400, $500, even $800 less than his 6-month premium. His loyal rate isn't a discount. It's a joke. He's been paying the sucker price for years. That feeling Dave had? That mix of anger, embarrassment, and betrayal? I want you to channel that. Because the single most important step to saving money on car insurance has nothing to do with bundling policies or raising deductibles. It is a psychological shift. It is the realization that your insurance company is not your friend. It is not your partner. It is a business and you are a line item on a spreadsheet. Your goal is to pay as little as possible for the best possible coverage. Their goal is to charge you as much as possible for that same coverage. It is an adversarial relationship, and until now, you've been playing defense without even knowing the game was happening. So, the first rule of saving money on car insurance is to have no loyalty. 0. Your loyalty should be to your wallet, to your bank account, to your family's financial future. You need to become a free agent. You need to be willing to walk away at every single renewal period. Now, I know what some of you are thinking because it's a fear these companies have expertly cultivated. But won't shopping around for insurance hurt my credit score? This is one of the most persistent and damaging myths out there, and it stops millions of people from saving money. Let's shatter it right now. When you apply for a loan, a mortgage, a car loan, a new credit card, the lender does what's called a hard inquiry, or a hard pull on your credit. This can temporarily ding your score by a few points because it signals to the credit bureaus that you're seeking new debt. But when you get an insurance quote, the insurance company does a soft inquiry, or a soft pull. A soft pull is like you checking your own credit score. It has absolutely zero effect on your credit rating. Let me repeat that. Getting an insurance quote has no impact on your credit score. You can get one quote or you can get 50 quotes. Your FICO score will not budge one single point. Think of it like this. A hard pull is like asking a bank for a $100,000 loan. A soft pull is like looking at the price tag on a car in the showroom. One is a serious financial application. The other is just gathering information. So the fear that you're damaging your credit by shopping around is completely unfounded. It's a ghost story and it's costing you money. The only thing you risk by shopping for insurance is discovering that you, like Dave, have been massively overpaying for years. So where does that leave us? We've established the core problem, the loyalty penalty. It's the silent tax you pay for not rocking the boat. We've established the core mindset shift. You must become a mercenary, loyal only to the best price. And we've debunked the biggest myth that holds people back, the fear of damaging your credit score. You are now armed with the foundational truth of this entire process. You're ready to break the cycle. You're ready to stop being a passive customer and start being an active, aggressive shopper. But before you rush off to the quote comparison websites, there's a critical next step. Because getting 100 quotes is useless if you don't know what you're actually quoting. You could end up buying a policy that's cheaper, sure, but one that leaves you dangerously exposed, with coverage gaps big enough to drive a truck through. Or you might be massively overinsured, paying a premium for protections you'll never ever need. Your current policy has a name. It's called the declarations page. It's probably sitting in your glove box or in a file folder somewhere, and it is the Rosetta Stone to saving money. It looks like a confusing wall of numbers and legal jargon, but it holds all the secrets. And in the next part, we're going to pull it out and dissect it line by painful line. We're going to translate every single term: bodily injury liability, uninsured motorist collision comprehensive MedPay into plain English. You're going to finally understand what you've been paying for, what you absolutely must have, and where the hidden opportunities for massive savings are hiding in plain sight. This next step is where we stop talking theory and start getting tactical. This is where the real savings begin. The single biggest mistake that costs drivers hundreds, even thousands of dollars a year, isn't a speeding ticket or a fender bender. It's a misplaced sense of loyalty. We are conditioned to believe that loyalty is rewarded. Stick with a company and they'll take care of you, right? With auto insurance, that is a dangerously expensive assumption. Insurers have a name for the phenomenon where longtime customers pay more than new ones for the exact same coverage. It's called price optimization, but a more honest name for it is the loyalty tax. They are betting on the fact that you won't go through the hassle of switching. They slowly, almost imperceptibly, raise your rates year after year, counting on your inertia. They know you're busy. They know you'd rather watch Netflix than compare insurance quotes. And that inertia is costing you a fortune. Think about it. When was the last time you truly shopped for car insurance? Not just renewed, but actually shopped? For many, the answer is when I bought my car, or even when my parents first put me on their policy. If that's you, I want you to listen very closely. You are almost certainly overpaying. An insurer's best customer is the one who never checks the competition. Your mission starting today is to become their worst nightmare. An informed, empowered consumer who actively seeks the best deal. So how do we do this? Your first tactical objective is to get at least 3 to 5 quotes from different insurance companies. I know that sounds like an afternoon of agonizing phone calls and endless online forms. A decade ago it was. But today you have 2 powerful allies in this fight: independent insurance agents and online comparison websites. An independent agent is a professional who works with multiple insurance companies, not just one. Their job is to take your information once and then shop it around to their network of carriers to find you the best policy. It's a fantastic service and it doesn't cost you anything extra. They get paid a commission by the insurance company they place you with. The second option is using one of the many online comparison tools. You enter your information once, and their technology pulls quotes from a dozen or more insurers in minutes. The key is to get a broad sample. Get a quote from a giant national brand like Geico or Progressive, a company that primarily uses local agents like State Farm or Allstate, and a smaller regional insurer if you can. You will be shocked by the difference in price for the exact same coverage. I've seen quotes for the same driver and vehicle vary by over $1,000 a year. That's a vacation. That's a new laptop. That's your money, and it's time to take it back. Now, as you start getting these quotes, you're going to be asked a lot of questions. This is not the time to rush. Every single question is a potential key to unlocking a discount. You need to think of this part as a treasure hunt. The insurance company isn't going to volunteer these savings. You have to actively hunt for them. Let's run through the most common and most commonly missed discounts. First, the big one, bundling. This is also called a multi-policy discount. If you have renters or homeowners insurance, get a quote from that same company for your auto insurance. Insurers love bundles because it makes you a stickier customer, less likely to leave. In return, they often give a substantial discount, sometimes up to 25% on both policies. Next, are you a good student, or do you have one on your policy? If you or a young driver in your household maintains a B average or better, that's a discount. Send them the report card. It's proof that the driver is responsible, and insurance is all about rewarding responsibility. How about your professional life? This is a huge one people miss. Are you a teacher, a nurse, an engineer, a first responder, or in the military? Many companies have affinity discounts for people in certain professions. Are you a member of an alumni association, a credit union, a warehouse club like Costco, or even an organization like AARP? Explicitly ask your agent, do you have any discounts for alumni of your university? Or, is there a discount for members of your credit union? The worst they can say is no, but a yes could save you 5 to 15%. Think about how you drive. Have you taken a defensive driving course? In many states, completing an approved course can shave a nice percentage off your premium for 3 years. The cost of the course, which you can often take online for around $25, is usually paid back in savings within the first few months. It's a no-brainer. Now let's talk about your car itself. Does it have anti-lock brakes? An anti-theft system? Daytime running lights? These are all safety and security features that reduce the insurer's risk, and they will reward you for them. Make sure these features are listed on your policy. And finally, the easy ones. Agreeing to receive your documents online instead of by mail? That's a paperless discount. Setting up automatic payments from your bank account? That's an autopay discount. Paying your entire 6-month or 1-year premium upfront instead of in monthly installments? That's a paid-in-full discount, and it can be a big one because it saves them administrative costs and ensures they get their money. Each one might only be a few bucks a month, but they add up to serious cash over the course of a year. Okay, so you're shopping around and you're hunting for discounts. The next tactical lever you can pull is your deductible. This is one of the fastest ways to change your premium, but you have to do it smartly. Your deductible is the amount of money you have to pay out of pocket for a claim on your collision or comprehensive coverage before the insurance company pays a dime. Think of it as your skin in the game. The higher your deductible, the more financial risk you're willing to take on yourself, and the lower your monthly premium will be. Most people default to a $500 deductible, but I want you to go to your agent or your online quote tool and just see what happens to your price when you raise that deductible to $1,000 or even $1,500. The savings can be significant, often 15 to 30% off your collision and comprehensive costs. Now, here is the golden rule of deductibles. Never raise your deductible to an amount you do not have readily available in an emergency fund. If you have a $1,000 deductible, you must have $1,000 in the bank that you can access tomorrow without causing a financial crisis. If you don't, leave the deductible where it is. But if you do have that cash cushion, raising your deductible is a powerful strategy. Let's say raising it from $500 to $1,000 saves you $30 a month. That's $360 a year. In less than 2 years, you've saved more than the $500 difference in the deductible itself. From that point on, it's pure profit in your pocket. The last major tactic for today is making the tough call on the coverage itself, specifically collision and comprehensive. As we discussed, these coverages pay to repair or replace your car if it's damaged. But they are optional and they are expensive. And at a certain point, they stop making financial sense. The question is, when is that point? A good rule of thumb is the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's current cash value, it might be time to drop them. Let's say you have a 13-year-old car. You look it up on Kelley Blue Book and find its private party sale value is about $4,000. Your insurance bill shows you're paying $500 per year just for collision and comprehensive. That's more than 10% of the car's value. Now, consider your $500 deductible. If you wreck the car completely, the absolute maximum the insurance company will pay you is $3,500. $4,000 value minus your $500 deductible. Is it worth paying $500 every single year to protect a potential payout of $3,500? For many people, the answer is no. They are better off self-insuring. That means dropping the coverage, banking the $500 you save each year, and accepting the risk that if they wreck the car, they'll have to pay to replace it themselves. It's a personal financial decision, but for anyone driving an older car with a low market value, it's a calculation you absolutely must make. Just by doing these things, aggressively shopping around, hunting down every last discount, intelligently setting your deductible, and making a smart decision about your coverage, you have already put yourself in a position to slash your auto insurance bill. You've taken control. But there's another factor, a silent number that follows you everywhere. That can have an even bigger impact on your rates than your driving record. In many states, it's the secret ingredient in your insurance price, and most people have no idea how much it's costing them. We're going to pull back the curtain on that next. That secret ingredient is your credit score. Yes, you heard that right. The same number that determines if you get a loan for a house or a new credit card is, in most of the country, a massive factor in how much you pay to insure your car. It's called a credit-based insurance score. And for millions of Americans, it's a silent killer of their budget. Insurers have mountains of data, and what that data tells them is that there's a strong statistical correlation between how a person manages their finances and how likely they are to file an insurance claim. Now let's be crystal clear. This doesn't mean that if you have a low credit score, you're a bad driver. It doesn't mean you're a bad person. It's not a judgment on your character. It's a game of statistics. From an insurer's perspective, a person who consistently pays their bills on time and manages debt responsibly is statistically less likely to, for example, miss a small repair on their car that later leads to a major accident, or to file a fraudulent or exaggerated claim. They see financial responsibility as a proxy for overall responsibility. Is this fair? That's a huge debate. In fact, it's so controversial that a handful of states, including California, Hawaii, and Massachusetts, have banned or severely limited the use of credit scores in setting auto insurance rates. But for the vast majority of the country, it's fair game. And the impact is staggering. A study by the Zebra found that a driver with poor credit could pay over $1,700 more per year than an identical driver with excellent credit. Let that sink in. Same car, same address, same driving record, same coverage. The only difference is the credit score, and it costs one person the price of a nice vacation every single year. This is why understanding your credit is not just a nice financial habit. It is a critical money-saving tool for your car insurance. So how do we fight back? How do we turn this system to our advantage? It starts by understanding what they're actually looking at. Your credit-based insurance score is not the same as the FICO or Vantage score you see on your credit card app. It's a specialized score, but it's built from the exact same raw material. Your credit report. It pulls information from your history with Experian, Equifax, and TransUnion and weighs it differently. It's less concerned with how much credit you could get and more focused on how you've managed the credit you already have. Let's break down the 5 pillars of your credit that directly feed into this insurance score. Think of this as the recipe insurance companies use to cook up your rate. First and most importantly is your payment history. This is about 40% of your insurance score. It's the king. It's simple. Do you pay your bills on time? Every late payment, every collection account, Every default is a major red flag. A single missed payment from 2 years ago can still be dragging your rate down today. Consistency is everything here. Second is what's called your credit utilization, or your outstanding debt. This is about 30% of your score. This sounds complicated, but it's just a ratio of how much you owe versus how much credit you have available. Imagine your total credit card limit is $10,000. If you have a $3,000 balance, your utilization is 30%. If you have a $9,000 balance, it's 90%. To an insurer, a high utilization ratio signals financial stress. It suggests you might be overextended and statistically, more likely to take risks or file a claim to cover a cost you can't afford. The golden rule is to keep your overall utilization below 30%. Below 10% is even better. Third is the length of your credit history. This is about 15% of the score. The longer you've responsibly managed credit, the more predictable you are. An insurer looks at a long, stable credit history like a long, stable driving record. It shows a pattern of behavior over time. This is why you should think twice before closing your oldest credit card, even if you don't use it much. That card is like a wise old anchor for your credit age. Closing it can actually shorten your history and hurt your score. Fourth is your pursuit of new credit. This is about 10%. Are you constantly applying for new loans and credit cards? Every time you apply, it triggers what's called a hard inquiry on your report. 1 or 2 a year is no big deal. But a flurry of applications in a short period can look like desperation to an insurer. It's another sign of potential financial instability, which in their world equals risk. And fifth, making up the last 5%, is your credit mix. This is a minor one, but it helps. Insurers like to see that you can responsibly manage different kinds of debt. For example, a mix of revolving credit like credit cards and installment loans like a car loan or a mortgage. It shows you're a versatile and experienced borrower. So that's the recipe. Pay on time, keep balances low, maintain a long history, apply for new credit sparingly, and have a healthy mix. Now, for the most important part, how do you take this knowledge and turn it into real dollars back in your pocket? Your first step, and you should do this today, is to get a copy of your credit report. Not your score, your full report. By law, you are entitled to a free report from each of the 3 major bureaus, Experian, Equifax, and TransUnion, once every year. The only place you should go to get this is the official, government-mandated site, annualcreditreport.com. It's free, it's safe, and checking your own report does not hurt your score. That's a myth. Once you have your reports, go through them with a fine-tooth comb. You are looking for errors. A 2021 study by Consumer Reports found that over a third of Americans found at least one error on their credit report. This could be a late payment that wasn't actually late, an account that doesn't belong to you, or a debt that's been paid off but is still showing a balance. These errors can be anchors, weighing down your score and inflating your insurance premium without you even knowing it. If you find an error, dispute it immediately. Each credit bureau has a straightforward online process for filing a dispute. Fixing a single error can sometimes cause your score to jump 20, 50, even 100 points, which could translate into hundreds of dollars in insurance savings. After you've cleaned up any errors, it's time to play the long game of building good credit. The strategy is simple, but it requires discipline. First, automate everything. Set up automatic payments for every single bill you have: credit cards, student loans, your cell phone. This single action makes it virtually impossible to have a late payment, which, as we discussed, is the biggest factor in your score. Set it and forget it. Second, attack your credit card balances. If you're carrying high-interest debt, make a plan to pay it down. The 2 most popular methods are the avalanche method, where you pay off the highest interest card first, and the snowball method, where you pay off the smallest balance first to get a quick psychological win. Either way, the goal is to get that utilization ratio down below 30%. Every percentage point you lower it helps your score. Third, be patient. Building a strong credit history doesn't happen overnight. It's the result of months and years of consistent, responsible behavior. But here's the good news. Insurance companies don't just check your score when you first sign up. They often reevaluate it at your renewal period, which is typically every 6 or 12 months. This means the positive changes you make today can lead to a lower rate in as little as half a year. By taking control of your credit, you are taking control of one of the most powerful hidden factors in your auto insurance price. You're turning the tables on the insurance companies and using their own system to your benefit. It's one of the most impactful things you can do to lower your costs, not just for insurance, but for every major financial decision in your life. But fixing the numbers behind the curtain is only half the battle. What about the discounts that are right there on the surface just waiting for you to claim them? Most people assume their insurance company is automatically giving them every discount they qualify for. That is a massive and very expensive mistake. There are dozens of potential discounts available, and often you only get them if you ask. You'd be shocked how many people leave hundreds of dollars a year on the table because they don't know the magic words to say. In the next part, we're going to arm you with the ultimate checklist of discounts you need to demand from your insurance agent. Alright, let's open the vault. This is the ultimate discount checklist. Think of this not as a list of suggestions, but as a series of non-negotiable demands. Insurance companies are not going to volunteer these savings. They have them, they're available, but they often wait for you to ask. It's like a secret menu at a restaurant. You only get the good stuff if you know the secret words. So, get ready to write these down because we're about to turn you into their least profitable and most respected customer. We're going to break this down into 4 categories of discounts. Discounts about you, discounts about your CAR, discounts about your policy, and finally the wildcard discounts that almost nobody knows about. Let's start with the first and most personal category. Discounts about you. These are based on who you are, what you do, and how you live your life. First up, the classic good student discount. If you or a driver on your policy is in high school or a full-time college student and maintains a B average or better, typically a 3.0 GPA, you could be looking at a discount of anywhere from 10 to 25%. This is a massive one. For a young driver whose rates are already sky high, this discount alone can save over $500 a year. Don't just assume they know your kid is an honor roll student. You have to send them the report card. You have to demand the discount. Next, and this one is huge, is the professional or occupational discount. Are you a teacher, a nurse, a doctor, an engineer, a scientist, a police officer, a firefighter, a member of the military? Insurance companies have crunched the numbers and found that people in certain professions are statistically safer drivers. They are less of a risk. As a reward, they offer a discount that can be up to 15%. And the list of qualifying professions is way longer than you think. Many companies offer discounts for accountants, architects, and even librarians. So you have to ask the magic question. Do you offer an occupational discount for my profession as your job here? If they say no, ask them to list which professions do qualify. You might be surprised. Then there's the senior or mature driver discount. If you're over a certain age, usually 50 or 55, and have a clean driving record, you can often get a nice little percentage shaved off your premium. Sometimes this is tied to completing a certified defensive driving course, which we'll talk about in a minute, but often it's just for being an experienced, safe driver. It's their way of saying, thanks for not being a reckless teenager anymore. Finally, in the U category is the homeowner discount. This is different from bundling, which we'll get to. Simply owning a home, even if your home insurance is with a different company, makes you seem more stable and responsible in the eyes of the insurer. It's a sign of stability. It suggests you're less likely to be a risk on the road. Many companies will give you a small discount just for being a homeowner. You just have to tell them you are one. Okay, let's move to category 2, discounts about your CAR. The machine itself. This is where your choice of vehicle can pay you back. The most important one here is the safety and security features discount. Does your car have anti-lock brakes, airbags, daytime running lights, an anti-theft system? Every single one of these can be its own separate discount. We're talking 3% here, 5% there. It adds up. When you get a quote, they'll ask for your car's VIN, or vehicle identification number. This should automatically pull most of this data. But you should never trust the system. You need to be your own advocate. Verbally confirm with the agent. I just want to make sure I'm getting credit for the anti-lock brakes, the passive restraint system, and the factory-installed anti-theft device. Use their language. Shows you know what you're talking about. If you have an aftermarket alarm system like a LoJack, that's another discount you need to scream from the rooftops. Next is the new car discount. Insurers love new cars. They're reliable, they have the latest safety features, and they're less likely to break down in the middle of traffic and cause an accident. If your car is less than 3 years old, you are almost certainly eligible for a discount. Make sure it's on there. Now for category 3, discounts about your policy. This is how you structure your deal with the insurance company, and it's where some of the biggest savings are hiding. The king of them all is the multi-policy or bundling discount. This is the one you see in all the commercials. If you have your auto insurance and your home insurance or renter's insurance with the same company, you can get a massive discount, sometimes as high as 25 or 30% on both policies. It's the combo meal of insurance. It is almost always cheaper to bundle. If you own a home or rent an apartment, and you aren't bundling, you are basically lighting money on fire. Even if you have to switch your home or renter's insurance to do it, the combined savings are often worth the hassle. Next up is the pay in full discount. Insurance companies love getting their money up front. It saves them the administrative cost of processing monthly payments and eliminates the risk of you missing a payment. To incentivize this, they offer a significant discount if you pay your entire 6-month or 12-month premium at once. It can be a little painful to write that big check, but the savings, often 5 to 10%, are real. If you can afford to do it, you absolutely should. A related one is the automatic payments or EFT discount. If you can't pay in full, agreeing to have the payment automatically deducted from your bank account each month can still net you a small discount. And here's an easy one, the paperless discount. In 2024, there is no reason to get a fat envelope from your insurer every month. Sign up for paperless billing and e-delivery of documents. It saves them money on printing and postage, and they'll pass a small piece of that savings on to you. It's usually just a few bucks a month, but why leave it on the table? It's free money. Finally, we have the loyalty discount. This one is tricky. Some companies will reward you for staying with them for a long time, say 3 years or more. But here's the trap. Often the loyalty tax, where they slowly creep your rates up year after year, is much larger than any loyalty discount they give you. So while you should always ask, how long have I been a customer and is there a loyalty discount I'm eligible for? Don't ever let it stop you from shopping around. Loyalty is a one-way street in this business. Okay, on to our last and most exciting category, the wildcard discounts. These are the ones people rarely ask for. First, the big one, usage-based insurance or telematics. This is the program where you put a small device in your car or use a smartphone app that tracks your driving habits. It tracks things like how many miles you drive, how often you drive late at night, your braking habits, and your acceleration. Now I know what you're thinking, big brother. And yes, you are trading some privacy for savings. But if you are a genuinely safe driver who doesn't speed, doesn't slam on the brakes, and doesn't drive much, the savings can be astronomical, up to 40% in some cases. If you work from home or you're a weekend-only driver, you need to look into this. You're being subsidized by the commuters and the lead foots. It's time to get paid for your good habits. Another wild card is the defensive driving course discount. Many states and insurers will give you a discount of 5 to 10% for completing an approved defensive driving course. These can often be done online in a few hours for about 20 or 30 bucks. You pay $25 once, and you save $100 on your insurance for the next 3 years. The math on that is pretty simple. It's one of the best returns on investment you will ever find. And one last one, the affiliation discount. Are you a member of an alumni association, a credit union, a wholesale club like Costco, or a professional organization? Many of these groups have negotiated special group rates with insurance companies. You could be a member of AAA, AARP, or even a specific university alumni group and have a discount waiting for you that you never knew existed. You have to ask, do you have any affiliation programs with clubs, universities, or organizations? So there it is. Your checklist. Your secret menu. The good student, the professional, the homeowner. The safety features, the new car. The bundling, the pay in full, the paperless. And the wild cards. Telematics and defensive driving. Your homework is to go through this list, line by line, and identify every single one that applies to you. Write them down. Because having the list is one thing, but knowing exactly how to use it in a conversation with a trained insurance agent is another thing entirely. You now have the ammunition. You know what to ask for. But how you ask, the tone you use, and the order in which you present your case can be the difference between getting a tiny discount and completely revolutionizing your bill. Let's call this the art of the call, because that's exactly what it is. It's not a confrontation. It's not a complaint. It's a strategic conversation where you hold more cards than you think. The person on the other end of the line is just that, a person. They have a script, they have targets, and they deal with angry, demanding people all day long. Your goal is to be the highlight of their day. The polite, prepared, and reasonable customer they are genuinely happy to help. Politeness is your secret weapon. It costs you nothing and makes them want to find a solution for you. Before you even pick up the phone, get into the right headspace. You are not begging for scraps. You are a long-term, valuable customer, or a potentially valuable new one, and you are simply reviewing your financial arrangements to ensure they still make sense. You are a CEO of your own life, and this is just a routine budget review. That's the energy. Calm, confident, and in control. Have your documents in front of you. Your current policy declaration page. The competitor quotes you gathered. A notepad and a pen. Don't do this while you're driving or distracted. Give it your full attention for 20 minutes. Okay, you're ready. You dial the number. The first person you speak to is almost never the person who can help you. They are a gatekeeper. Your first objective is to get past the gatekeeper and to the department that has the power to change your rate. This department is often called customer retention or customer loyalty. So when the initial agent answers, you'll say something calm and friendly like this. Hi there, my name is, your name, and my policy number is, your policy number. I've been a customer for a number of years, and I'm calling today to review my policy and explore my options. Could you please transfer me to a specialist in the customer retention department? Notice the key phrases. Review my policy and explore my options. This is calm corporate speak. It's not aggressive. It signals to them that you're serious and that canceling is on the table, without you actually saying the word cancel. The phrase customer retention is magic. It tells them you know how the game is played and you need to speak to someone with authority. Now you're on the line with the right person. A retention specialist. Their entire job is to keep you as a customer. They have access to discounts and loyalty rates that the first-level agents do not. This is where the real conversation begins. Again, start with politeness. Hi, thanks for taking my call. As I mentioned, I've been a happy customer for years, and my policy is up for renewal soon. I'm just doing my due diligence and reviewing my rates, and I was hoping you could help me make sure I'm getting the best possible price. You've done 3 things here. You've reminded them of your loyalty. You've framed this as a collaborative effort, hoping you could help me. And you've set the stage for the discussion about price. Now you begin to present your evidence, but not as a list of demands. You present it as a series of discoveries or questions. This is crucial. It's less confrontational. Start with the low-hanging fruit you researched in the last part. You could say, while I was looking at my policy, I realized I'm not sure if all my discounts are applied correctly. For instance, my car has anti-lock brakes and daytime running lights. Can you just confirm for me that I'm getting those discounts? Let them look it up. Let them confirm. This gets the ball rolling with small wins. Then you move on to the next piece of data. Also, I've been with you for 5 years now, and I've never had an accident or a ticket. Do you have a long-term customer discount or a safe driver discount that we can apply? I want to make sure my loyalty is being reflected in my rate. Again, you're asking a question. You're not demanding. The subtext is clear. Loyal, safe customers should be rewarded. Let them respond. They might find a 5 or 10% discount right there. Now you escalate slightly. You bring in your other life factors. That's great, thank you. I also noticed that my credit score has improved significantly since I first signed up. It's now in the excellent range. Since I know credit history can be a factor in rates, could we rerun the numbers to see how that impacts my premium? This is a brilliant move because it's based on a factual change in your status. It's not just you asking for a random discount. It's you providing new, positive information that justifies a rate reduction. After you've gone through the discounts and personal factors, it's time for the most powerful tool in any negotiation, the strategic pause. After you've asked them to look for these discounts and reevaluate based on your new information, you simply stop talking. Silence. It might feel awkward for a few seconds, but it's critical. You have made your case. The ball is now in their court. This silence pressures them to speak, to fill the void, and hopefully, to fill it with a solution. They will go through their computer clicking away, and then they will come back with an offer. Let's say they come back and say, okay, after applying the safe driver discount and rerunning your credit, I can get your 6-month premium down from $800 to $750. It's a start, but you're not done. Now it's time to introduce your trump card. The competitor quotes. Again, the tone is everything. It's not a threat. It's a dilemma you are sharing with them, hoping they can solve it. You say, okay, I really appreciate you doing that. That's definitely a step in the right direction. The main reason I called today is that, to be honest, I'm trying to justify staying with you. I've really enjoyed the service, but I just got a quote from Progressive for the exact same coverage, and they came in at $600 for the 6 months. That's a $150 difference. I would much rather stay with you guys, but that's a significant saving. Is there anything else you can do to help get closer to that number? Let's break that down. You complimented them. I appreciate you doing that. You expressed your desire to stay. I would much rather stay with you. You stated the competitor's price as a fact, not a weapon. And then you put the problem back in their lap with a collaborative question. Is there anything else you can do? This is the moment of truth. The retention agent now has to make a decision. They know you're not bluffing because you have a specific company and a specific price. They know you want to stay, which makes them want to work harder to keep you. They will likely put you on a brief hold while they talk to a supervisor or see what they can do. This is often where they unlock the final tier of discounts. They might come back and match it. They might come back and say, I can't do $600, but I can do $625. At this point, you have to decide if that $25 difference is worth the hassle of switching. Most of the time it's not. You've just saved yourself hundreds of dollars a year with a single polite 20-minute phone call. If they say they can't budge any further, you have one last gentle card to play. The reluctant goodbye. You say, well, I really do appreciate you trying. I'm disappointed because I do value your service, but a saving of the difference is just too much for me to ignore right now. Can you tell me what the process is for canceling my policy at the end of the term? This is the final signal. Sometimes, just asking about the cancellation process will trigger one last-ditch offer from them. If it doesn't, that's okay. You remain polite, thank them for their time and hang up. You haven't burned any bridges. And more importantly, you have a fantastic quote from another company that you are now free to accept. You literally cannot lose. This single phone call is the highest leverage thing you can do to save money. But what if you're already getting a great rate? What if the negotiation only gets you a little bit of savings? Don't worry. The negotiation is just one of the two major pillars of savings. The other pillar is a deep forensic audit of the discounts themselves, the ones hiding in plain sight that almost nobody knows to ask for. We're talking about discounts for your profession, for how you pay, even for the clubs you belong to. And getting those right is a whole different kind of art. And the first rule of this art is simple. They will almost never be offered to you. You have to ask. The insurance agent isn't a mind reader. They have no idea you were in the Sigma Chi fraternity, or that you're a member of the American Nurses Association, or that your alma mater has a deal with their underwriting department. This is on you. And this isn't about being pushy. It's about being informed. You're not asking for a favor. You're asking for a discount you are legitimately entitled to. So let's start with the big one, affinity groups. This is one of the most powerful and underutilized categories of discounts. Insurance companies love groups. Why? Because it's efficient. They can market to an entire organization at once, and they often have data showing that members of certain groups, be it an alumni association, a professional organization, or even a credit union, are more responsible, more financially stable, and therefore less risky to insure. Think about your own life for a second. Did you go to college? Call your alumni association. Seriously, right after this video, ask them if they have an insurance partner. Many major universities have negotiated special group rates for their alumni. It's a benefit of membership you're already paying for, or that is freely available to you. We're talking about a potential 5, 10, even 15% discount just for a degree you already earned. Are you a member of a professional organization? The American Bar Association, the National Education Association, the Institute of Electrical and Electronics Engineers? Almost all of them have these partnerships. The insurer sees a group of dedicated professionals and thinks, low risk. You should see it and think, low premium. This extends to wholesale clubs like Costco or Sam's Club, which have auto insurance programs. It applies to military members and their families. Organizations like USAA are built on this principle, but many other standard insurers offer significant military discounts as well, for both active duty and veterans. It's a thank you for your service that also happens to be good for their bottom line. The list goes on and on. Fraternities, sororities, credit unions, specific federal employee groups. Your job is to make a list of every single group you belong to, and when you're getting a quote, go down the list one by one. Do you offer a discount for this? What about this? Don't stop until you've exhausted the list. One yes can save you hundreds of dollars a year. Now let's get even more personal. Let's talk about your job. This is the occupation discount, and it's a fascinating window into how insurance companies think. They have mountains of data, decades of statistics that correlate professions with driving behavior. And they use that data to give certain careers a built-in discount. Who gets the gold star? Well, it varies by company, but there are common themes. Teachers and educators are often at the top of the list. The data suggests they're responsible, cautious, and less likely to be on the road late at night. Scientists and engineers are another favorite. The stereotype of being meticulous, analytical, and detail-oriented plays out in the data. They tend to be safer drivers. First responders, police officers, firefighters, EMTs often get a discount. Not only is it good PR for the insurance company, but these are people professionally trained to handle high-stress situations calmly, a skill that translates well to the road. Nurses and doctors are also frequently on the list. The key here is to be specific about your job title. Don't just say, "I work in an office." If you're an accountant, say that. If you're a research scientist, say that. The person on the other end of the phone is just looking for keywords to plug into their system. Give them the right keywords. And if your profession isn't on the preferred list, don't worry. This is just one of many discount levers we're going to pull. Next up, let's talk about the easiest money you will ever save: payment discounts. These are the low-hanging fruit. The first is the pay in full discount. Insurance companies love getting all their money up front. It eliminates the risk of you missing a monthly payment, and it dramatically reduces their administrative and billing costs. To incentivize you, they'll often knock a significant chunk off your total premium, sometimes as much as 10%. If you have the cash available in savings, paying your 6-month or 1-year premium in a single lump sum is often a fantastic return on your money. Think about it. Where else can you get a guaranteed 10% return in a single day? Can't swing the pay in full option? No problem. The next best thing is the automatic payment, or EFT discount. EFT stands for Electronic Funds Transfer. By allowing the company to automatically pull the payment from your checking account or credit card each month, you're again reducing their risk and administrative overhead. They don't have to worry about a check getting lost in the mail or you forgetting to pay. For this simple convenience, they'll usually give you a small but still meaningful discount. It might only be $5 or $10 a month, but that's over $100 a year for doing nothing more than setting it and forgetting it. And while you're at it, sign up for paperless billing. Every bill, every policy document they have to print and mail costs them money in paper, ink, and postage. By agreeing to receive everything by email, you save them a few bucks, and they'll pass a tiny piece of that savings back to you. It might only be $1 or $2 a month, but we are stacking discounts here. Every single dollar counts. These 3 payment-related discounts, pay in full, autopay, and paperless, are practically free money. There is absolutely no reason not to claim them. Okay, let's move from how you pay to what you drive. Your car itself is a treasure trove of potential discounts, but only if you tell the insurance company what to look for. Let's start with safety. Modern cars are packed with features designed to prevent accidents or protect you during one. And insurers will reward you for every single one. But here's the catch. A lot of this is based on the vehicle identification number, or VIN. And sometimes, the standard features for a car model don't include everything your specific car has. You need to be your car's advocate. Did your car come with anti-lock brakes? ABS? That's a discount. Does it have daytime running lights? That's a discount. Does it have automatic emergency braking, blind spot monitoring, or lane departure warnings? Those are all potential discounts. List them out. Then there's anti-theft. This is a big one. Insurers break this down into 2 categories: passive and active. A passive device is one that works automatically. Think of a factory-installed alarm that arms itself when you lock the doors, or an engine immobilizer that prevents the car from being hot-wired. An active device is something you have to turn on, like the club steering wheel lock. Passive devices get you a bigger discount because there's no chance of you forgetting to use it. If your car has a built-in alarm or an immobilizer, make sure your insurer knows. If you've had a tracking system like LoJack installed, that's an even bigger discount. Even something as simple and low-tech as having the VIN etched onto your windows can sometimes earn you a small price break because it makes your car parts less valuable to thieves. The single biggest vehicle-related discount, however, might be the low-mileage discount. With the massive shift to remote work, millions of Americans are driving far less than they used to. Your insurance premium is based heavily on your estimated annual mileage. The less you're on the road, the lower your risk of getting into an accident. If your daily commute has gone from 25 miles to 25 feet, you need to call your insurance company immediately. They're still charging you as if you're a high-mileage commuter. By updating your mileage, you could see your premium drop by 10, 20, or even 30%. Most companies have thresholds like under 10,000 miles a year, or under 7,500. Find out what those thresholds are and see if you qualify. It's one of the most direct ways to align your premium with your actual risk. Finally, let's talk about the people on the policy. The good student discount is a classic. If you have a young driver on your policy, typically under 25, who is a full-time high school or college student and maintains a B average or better, you can get a substantial discount, often between 10 and 25%. The logic is simple. The discipline and responsibility it takes to be a good student is believed to translate into being a more responsible driver. You'll need to send in a copy of their report card or transcript each semester, but for the hundreds of dollars you'll save, it's well worth the effort. And here's a related pro-level tip: the student away at school discount. If that same college student is attending school more than 100 miles away from home and did not take a car with them, you can get a massive discount. They're still covered when they come home for holidays and breaks, but the insurer knows their risk of driving is practically zero for most of the year. This discount is huge, and so many parents don't even know it exists. All of these discounts, from your profession to your payment method to the safety features in your car, have one thing in common. They require you to be proactive. You have to raise your hand and ask the question. Think of it as a scavenger hunt, and every discount you find is a piece of your own money you get to keep. But stacking these conventional discounts is only half the battle, because there's a new frontier in auto insurance, a technology that tracks your every move behind the wheel, and it promises the biggest discounts of all, if you're willing to let Big Brother ride shotgun. This technology goes by a few names: telematics, usage-based insurance, or even just a safe driver program. But the concept is simple. Instead of judging you based on broad statistics for your age, your zip code, and your driving record, the insurance company wants to judge you on one thing and one thing only: how you actually drive right now. The promise is seductive. If you can prove you're a safe driver, you can get a discount that's impossible to get any other way, sometimes as high as 30 or even 40%. It's the ultimate personalized rate. But that proof comes at a price: your privacy. So how does it work? There are two main ways the insurance company spies on you, monitors your driving. The first is a small device, often called a dongle, that you plug directly into your car's OBD2 port. That's the little port under your steering wheel that your mechanic uses to diagnose a check engine light. It's been standard on every car sold in the US since 1996. Once plugged in, this device uses GPS and internal sensors to track your car's every move. The second, and increasingly common method, is through a smartphone app. You download your insurer's app, give it a bunch of permissions, and it uses your phone's built-in GPS and motion sensors to do the exact same thing. The app is arguably even more invasive because it knows when you're picking up your phone while driving. So what specifically are they watching for? It's not just about whether you get into an accident. They are building a complete digital profile of you as a driver, grading you on a handful of key behaviors. First, and most importantly, braking and acceleration. Are you a smooth operator? Or are you constantly slamming on the brakes and peeling out from stoplights? Every single instance of hard braking or rapid acceleration dings your score. The problem is, their definition of hard might be very different from yours. Did you have to brake suddenly because a kid ran into the street? The algorithm doesn't know or care. It just sees a data point that flags you as an aggressive, high-risk driver. Second, speed. They are comparing your speed to the posted speed limit of the road you're on. Consistently going 5 or 10 miles over the limit will tank your score. This seems straightforward, but what about when you're just keeping up with the flow of traffic on the highway? If everyone is going 75 and a 65, the algorithm sees you as a speeder, while a human would see you as a normal, safe driver in that context. Third, time of day. This is a big one. Driving between midnight and 4 a.m. is statistically much riskier due to fatigue and a higher likelihood of impaired drivers on the road. The algorithm penalizes you heavily for late-night trips, regardless of the reason. Are you a nurse coming home from a night shift? A parent picking up a sick kid? Too bad. In the eyes of the insurer, you're a high-risk night owl. Fourth, mileage. This is simpler. The less you drive, the less risk you have of getting into an accident. Telematics tracks your exact mileage. If you're a remote worker who only drives a few thousand miles a year, this can be a huge benefit. But if your commute is long or you take frequent road trips, this will work against you. And finally, if you're using the smartphone app, they're watching for distracted driving. The app's sensors can detect when you pick up your phone, make a handheld call, or are actively texting while the car is in motion. This is the ultimate gotcha for many people. Now, after a trial period, usually around 90 days, the company analyzes all this data and assigns you a driving score. A high score gets you a big discount. A low score, well, this is where it gets complicated. So let's break down the good, the bad, and the ugly of usage-based insurance. The good is obvious, the money. If you are genuinely the perfect driver in the eyes of the algorithm, you can save a significant amount. Think about who this benefits. A retiree who drives carefully to the grocery store twice a week. A remote worker whose car barely leaves the garage. A new teenage driver whose parents want to monitor their habits and are confident they'll drive like a saint. For these people, telematics is a game changer. It allows them to separate themselves from the statistical herd and prove their individual safety, earning a discount they absolutely deserve. Some companies will even give you a small initial discount of 5 or 10% just for signing up and trying the program. But then there's the bad. The first and most obvious issue is privacy. You are handing over an enormous, continuous stream of personal location data to a massive corporation. They know where you live, where you work, where you shop, where your kids go to school. They know you visited a doctor, a bar, or a divorce lawyer. Insurers swear this data is protected and only used for calculating your rate. But data breaches happen. Policies change. And you have to ask yourself, are you comfortable with your insurance company having a minute-by-minute log of your life? The other bad part is the unforgiving nature of the algorithm. It lacks context. That heartbreaking event when a deer jumped in front of your car? That counts against you. That one time you had to speed up to safely merge onto a chaotic freeway? That counts against you. That late-night drive to the emergency room? That counts against you. You are being judged by a machine that assumes the worst about every single action that deviates from a perfect pre-programmed ideal. It creates a stressful driving experience, where you're more worried about your score than about navigating real-world road conditions. And that brings us to the ugly. This is the part they don't like to advertise. While most major carriers promise that a bad score won't raise your rates, this isn't a universal rule. Some smaller or less reputable companies absolutely reserve the right to surcharge you. That is, increase your premium. If your driving data identifies you as a high-risk client, you could sign up hoping for a discount and end up with a higher bill than when you started. You are essentially gambling with your insurance rate. Furthermore, what happens to this data if you're in an accident? Can the other party's lawyer subpoena it? Can your own insurance company use it to deny or reduce your claim? The legal landscape around this is still murky and evolving, but it's a terrifying possibility. Imagine your insurer arguing you were 10% at fault for an accident because your telematics data showed you were going 3 miles per hour over the speed limit just before impact. So, who should actually consider this? The ideal candidate is someone with a very predictable, safe, and low-mileage driving pattern. Think remote workers, stay-at-home parents, or retirees. You also need to be genuinely comfortable with the data sharing aspect. If the thought of a corporation tracking your every move makes your skin crawl, the potential savings are not worth the peace of mind. Who should absolutely avoid it? Anyone with a lead foot, people who work night shifts, salespeople, delivery drivers, or anyone who puts a lot of miles on their car for a living. And frankly, anyone who values their privacy above all else. If you're on the fence, here is the single most important piece of advice. Before you agree to anything, you must ask the insurance agent 2 very specific, non-negotiable questions. First, can my rate go up based on the data from this program? Get a clear, unambiguous yes or no. If they say yes, or if they get evasive, it's probably not worth the risk. Second, what is your company's specific policy on sharing my telematics data with third parties or using it in the event of a claim? Make them explain it in detail. If you don't like the answer, walk away. Telematics offers a tantalizing bargain. Trade your privacy for a lower price. For the right person, it's a fantastic deal. For the wrong person, it's a trap that can lead to higher rates and a constant sense of being watched. Choosing the right discounts and deciding whether to gamble on telematics is a huge step toward locking in the lowest possible rate. But your job isn't over once you've signed the policy. In fact, for many people, the most expensive mistake they'll ever make happens after they have the perfect insurance. It's a moment of panic and confusion, and how you handle it can cost you thousands or even your entire policy. I'm talking about what to do when you actually get into an accident. So the worst has happened. You hear the crunch of metal, the sickening sound of plastic shattering, and the jolt that throws you against your seatbelt. Your heart is hammering against your ribs. In that moment, your brain is a cocktail of adrenaline and confusion, and what you do in the next 60 seconds the next 10 minutes, and the next 24 hours will have a greater impact on your financial future than any discount code or bundle you ever found. This is where the rubber meets the road, literally, and where your insurance policy transforms from a piece of paper into a financial lifeline. The very first thing you do before anything else is take a deep breath and check on yourself and your passengers. Are you okay? Is everyone conscious? If there is any doubt whatsoever about injuries, your first and only action is to call 911. Don't be a hero. Don't try to assess the situation yourself. Paramedics are trained for this. Your health is infinitely more valuable than your car. Assuming everyone is okay and the cars are not in a dangerous position like the middle of a highway, the next step is critical. Do not move your vehicle. I know the instinct is to pull over to the side of the road to be courteous, but you've just destroyed the crime scene. The position of the cars, the skid marks, the debris. It all tells a story your insurance company needs to read. Only move your cars if you are creating an immediate danger to other traffic. Otherwise, put your hazards on, put the car in park, and get out your phone. Your phone is now the most important tool you own. You are about to become a detective, and your goal is to document everything. Open your camera and start taking pictures. Take way more than you think you need. Get wide shots of the entire scene from every angle. Capture the position of the cars relative to each other and to the road. Get photos of the traffic signs, the speed limit signs, any stoplights. Is the sun in someone's eyes? Is the road wet? Document it. Then get close-ups. Photograph the damage on your car from multiple angles. Do the same for the other vehicle. And this is a pro tip. Take a photo of the other car's license plate immediately. People can get flustered and you don't want to forget it. Now you have to talk to the other driver. This is where people make catastrophic mistakes. Your adrenaline is high, you might feel guilty even if it wasn't your fault. The urge to say, "I'm so sorry," is powerful. You must fight that urge. In the eyes of the law and insurance companies, "I'm sorry" can be interpreted as an admission of fault. It can be used against you to deny your claim, or even make you liable for all the damages. You need to be polite, calm, and robotic. Your script is simple. First ask, "Are you okay?" It shows humanity. Then you state, "We need to exchange information." That's it. You do not discuss the accident. You do not say, "I didn't see you," or "I was in a hurry." You do not blame them. You say nothing about how the accident happened. If they try to engage you, if they start yelling or blaming, you simply repeat, "Let's just exchange information and wait for the police." You need to get 3 things from them, and you're going to use your phone to do it. Ask to see their driver's license and take a clear picture of it. Ask to see their insurance card and take a clear picture of it. Make sure it's the current one. And get their phone number. Give them the same information of yours. Be cooperative, but be a closed book. The next step is non-negotiable. Even for what seems like a minor fender bender, you must call the police. The other driver might try to talk you out of it. They'll say, "Hey, let's just handle this between ourselves. No need to get insurance involved. It'll just raise our rates." This is a massive red flag. This is the biggest trap in the post-accident playbook. Here's why. That minor damage they want to pay you $500 for could easily be hiding thousands of dollars in structural damage underneath the bumper. That little neck ache you feel could turn into a major whiplash injury tomorrow morning that requires months of physical therapy. If you don't file a police report, it becomes your word against theirs. They can later claim you hit them somewhere else. They can deny the accident ever happened. They can change their story completely when they talk to their insurance company. A police report is an official, third-party account of the incident. It locks in the details while they're fresh. It is your single greatest piece of evidence. Without it, you are gambling with your financial future. When the police arrive, state the facts as you know them. Don't speculate, don't guess. Just say what you saw and what you did. Get the officer's name and badge number, and ask for the police report number. Okay, the scene is secured, the police are on their way, and you've exchanged information. Now it's time to make the second most important call of the day, the one to your insurance company. Many companies have a 24/7 claims hotline or a feature in their app to start a claim right at the scene. Use it. The sooner you report the accident, the better. Your memory is fresh. The details are clear. When you speak to the claims representative, you will use the same strategy you used with the other driver and the police. You are a reporter, not a storyteller. Stick to the objective facts. I was driving on Main Street at approximately 3 p.m. A blue sedan, license plate XYZ, ran a red light and struck the passenger side of my vehicle. I have photos of the scene and the other driver's information. A police report has been filed. They will ask if you are injured. Be honest. If you feel fine, say that. But it's also wise to say something like, I feel okay right now, but I'm a little shaken up. I'm going to get checked out by a doctor just to be safe. Adrenaline can mask injuries. What feels like nothing today can be a serious problem tomorrow. By mentioning it, you're keeping the door open for medical coverage if you need it later. If you say no, I'm not injured at all, and later discover you have a back injury, the insurance company can use your initial statement to fight your medical claim. After this initial call, you'll be assigned a claims adjuster. And you need to understand something fundamental about this person. The claims adjuster, even if they are friendly, even if they sound incredibly helpful, does not work for you. They work for the insurance company. Their primary job is to protect the company's financial interests and to settle your claim for the lowest amount legally possible. They are not your advocate. This is why all your documentation, the photos, the police report is so vital. You are building a case. Every time you speak with the adjuster, make a note of the date, time, their name, and what you discussed. If they promise you something like they'll cover a rental car for 10 days, follow up with a polite email confirming the conversation. Hi John. Just wanted to confirm our conversation today where you approved a rental car for up to 10 days. Thanks again for your help. This creates a paper trail. It keeps everyone honest. They will want you to give a recorded statement. You should be cautious. You can agree, but it's often wise to say, I'd be happy to, but I'd like to have all my documentation in front of me. Can we schedule it for tomorrow? This gives you time to calm down, review your notes, and prepare. During the statement, again, stick to the facts. Do not offer opinions. Do not apologize. Do not take responsibility. Just answer the questions asked, simply and truthfully. You've done everything right. You've protected your health, secured the scene, documented the evidence, and initiated the claim like a professional. You've navigated the most stressful part of car ownership and set yourself up for the best possible outcome. You think the hard part is over, but in the coming weeks, a new battle begins. It's the fight over the value of your car, the cost of repairs, and the long-term impact on your insurance premiums. You've survived the crash, but now you have to survive the claim. And many people lose this fight before it even begins because they don't understand the hidden rules of the game. They accept the first offer, they use the wrong repair shop, and they trust the wrong people. And a few months later, they get a letter in the mail from their insurer. It's their policy renewal, and the price has skyrocketed. They feel cheated. They feel powerless. But the power was in their hands all along. They just didn't know how to use it. And that brings us to the final piece of the puzzle. The secret to not just surviving an accident, but ensuring it doesn't financially cripple you for the next 3 to 5 years. And that secret isn't some magic loophole or a hidden discount. It's a plan. It's a system you build before you ever need it so that in the chaotic, adrenaline-fueled moments after a crash, you're not guessing, you're executing. Because what nobody tells you is that the most expensive part of an accident often has nothing to do with the crumpled metal. It's the mistakes you make in the first 30 minutes. Think about it. The screech of tires, the sickening crunch. Your heart is hammering against your ribs. You get out of the car, your hands are shaking. The other driver is there, maybe they're yelling, maybe they're apologizing profusely. Your mind is a scrambled mess. And in that state, you're expected to become a detective, an evidence technician, a negotiator, and a medical professional all at once. It's an impossible task. And insurance companies know this. Your confusion is their leverage. A poorly documented claim is an easily denied claim. An emotional, off-the-cuff statement can be twisted into an admission of fault. And one wrong move can turn a simple fender bender into a 3-year sentence of sky-high premiums. So how do we fix this? We take the thinking out of it. We build a simple, foolproof system that runs on autopilot when your brain is in overdrive. This is your post-accident playbook, the single most valuable thing you will ever put in your car. And it costs you exactly $0 to create. It starts with your glove box. Right now, yours probably has old napkins, a tire pressure gauge, and maybe an owner's manual you've never opened. We're going to turn it into a command center. You need a simple folder or a large Ziploc bag. Inside, you will place 4 things. First, a current copy of your insurance card and your vehicle registration. Obvious, but you'd be shocked how many people can't find them. Second, a list of emergency contacts. Not just your spouse or parents, but your primary doctor and maybe even your preferred tow truck company if you have one. Third, a pen that actually works. Test it. And fourth, the most important piece, a pre-printed accident report worksheet. You can find dozens of these online for free. Just search for post-accident checklist. Print one out. It will have spaces for the other driver's name, their license plate, their insurance information, the location, the time, the police report number. It guides you through the exact information you need to collect, so you don't have to remember it in the heat of the moment. That's the physical part. Now for the digital fortress, your smartphone. Your phone is the most powerful evidence-gathering tool ever created, but only if you use it correctly. Everyone knows to take a picture of the damage. That's amateur hour. You are going to become a forensic photographer. First, before the cars are moved, if it's safe to do so, you take wide shots. Pictures of the entire intersection, the street signs, the traffic lights, the skid marks on the road, the weather conditions. Is the sun in someone's eyes? Is the road wet? This context is everything. It tells the story of how the accident happened. Second, you photograph the damage from multiple angles, both close up and from 10 feet away. But you also photograph the lack of damage on both cars. This prevents the other person from later claiming you caused some old dent on their bumper. Third, you take a picture of the other driver's license plate, then their driver's license, then their insurance card. Do not just write it down. A photo is undeniable proof. People make mistakes writing down policy numbers. A photo doesn't. And finally, the secret weapon. Once you're safely back in your car, you open your voice memo app, and you record yourself talking for 2 minutes. You state the date, the time, the location, and then you describe in your own words exactly what just happened from the moment you saw the other car to the moment of impact. You do this immediately while the details are crystal clear. This raw, unedited recording is for you and your lawyer only. It is an incredibly powerful tool to refresh your memory weeks or months later when an insurance adjuster is trying to poke holes in your story. Now, we have our physical kit and our digital evidence. But there's one more piece, and it's the hardest one. Controlling the conversation. What you say, and more importantly what you don't say, can save you thousands of dollars. The first words out of your mouth to the other driver should never be, "I'm sorry." In our society, "I'm sorry" is a polite way of showing empathy. In the world of insurance, "I'm sorry" is a recorded admission of fault. It will be used against you. Period. Instead, the first words you say are you okay?" You show concern for their well-being, which is the decent human thing to do, without accepting any blame. From that point on, your job is to be a polite, calm fact-gathering machine. You do not discuss the accident. You do not say, "I didn't see you," or "I was looking at my GPS." You don't argue about who had the green light. You simply state, "I need to get your information for our insurance companies." You use your checklist. You take your photos. You are cordial, but you are a closed book. Let the police and the insurance adjusters determine fault. That is their job, not yours. Your job is to protect yourself. When you call your insurance company to report the claim, the same rules apply. Stick to the facts you have documented. "I was traveling north on Elm Street. The other vehicle was a blue sedan. Here is the police report number." Don't offer theories. Don't speculate. If they ask a question you don't know the answer to, the correct response is not to guess. The correct response is, "I'm not sure," or "I'll have to check my notes on that." Every word you say on that recorded call is being analyzed to determine how they can pay out the least amount of money. So let's connect this back to the theme of this entire series: saving money. How does this system do that? Well, imagine 2 scenarios. In scenario 1, you have no plan. You get in a wreck, you forget to get the other driver's insurance, you emotionally say it was all my fault, and you have 2 blurry photos of your own bumper. Your claim is a nightmare. It gets delayed, disputed, and maybe even denied. Or worse, you're incorrectly assigned 100% of the fault. What happens next? Your premium, let's say it's $1,800 a year, gets hit with an at-fault surcharge. That can be a 30, 40, even 50% increase. Let's call it 40%. That's an extra $720 a year. And that surcharge stays on your record for 3 years. You just made a $2,160 mistake, all because you weren't prepared. Now scenario 2. You have your system. The accident happens. Adrenaline hits, but it doesn't matter. You're on autopilot. You pull out your checklist. You take 25 methodical photos. You record your voice memo. You say only what is necessary. You provide your insurance company with an airtight, undeniable, perfectly documented case. Your claim is processed quickly. The evidence clearly shows the other driver was at fault. Your rates don't go up a single penny. The system didn't just save you a headache. It saved you over $2,000. This is the final lesson. Saving money on car insurance isn't just about finding the cheapest rate today. It's about building a defensive wall around your financial future. We've spent this time together learning how to shop smarter, how to find every last discount, how to understand the complex language of your policy, and how to leverage your good habits for a better rate. We've put the power back in your hands. You are no longer just a customer. You are an expert in your own right. You understand the game. The ultimate goal was never just to have cheap insurance. It's to have peace of mind. It's the profound security of knowing that if the worst happens on the road, it will be a bad day, not a bad year. It will be an inconvenience, not a catastrophe. So your homework, your final task is to take 15 minutes tonight. Not tomorrow, not next week. Tonight. Go to your car. Clean out the glove box. Print that checklist. Create a note in your phone with a link to your insurance app and your policy number. Do it for yourself. Do it for your family. It is the single highest return investment of time you will ever make. It costs you nothing and it could save you everything. You now have the knowledge. You have the tools. Go and build your fortress.